You think the 400 million barrel release from global oil reserves just saved your portfolio from an energy shock. But the U.S. Navy has already signaled that escorts through the Strait of Hormuz are not yet possible, and shipping through the route remains severely disrupted. The bond market is reacting too. The 10-year Treasury yield pushed up to around 4.21%. As investors looked past February CPI, worried about the oil shock ahead, and digested a soft 10-year auction, the International Energy Agency did pull its biggest emergency lever ever, agreeing to release 400 million barrels from member country reserves. But the headline number is more impressive than the likely day-to-day relief. Reuters notes the current disruption is around 20 million barrels per day, while analysts say the actual release pace could offset only a fraction of that in the near term. Everyone is celebrating February CPI at 2.4%, with core CPI at 2.5%. But that report is backward-looking. It reflects February conditions before the war-driven energy shock hit in full. Since February 28th, U.S. average gasoline prices have jumped nearly 60 cents to about $3.58 per gallon, so the market is already pricing a hotter real-time inflation backdrop than today's CPI print alone suggests. Oil is still a major problem, but the price detail matters. As of March 11th, Brent was around 87.6 and WTI around 83.1. So saying WTI just blew past $87 is not accurate for today. A better line is that WTI surged sharply earlier this week, settling at $94.77 on March 9th and briefly spiking above $119 intraday before retreating. On private credit, the warning sign is real, but the wording should be tighter. JPMorgan has marked down the value of some loans tied to private credit funds and tightened lending to parts of the sector, particularly around software company exposure. In market trading, Ares fell 4.8% and Apollo slipped 1.9%, which supports the risk-off message without overstating it. On the AI side, Oracle did beat quarterly revenue estimates and lifted its AI-driven outlook through 2027, sending the stock up about 8.3% in extended trading. Nvidia also said it would invest $2 billion in Nebius. That supports your big-picture contrast between cash-rich infrastructure winners and more rate-sensitive borrowers, but the line that mega-caps do not care about a 4.2% 10-year yield is still commentary, not a hard fact. Tomorrow, the cleaner thing to say is, watch the 30-year Treasury auction and watch gasoline and diesel futures. If energy stays elevated, second-half margin assumptions across the market may have to come down. I am Wilson. See you tomorrow.